Hey, welcome to Grow Your Dough. So you want to learn to invest in the stock market. But of all the companies out there to invest in, which do you choose? There are over 1,100 stocks on the London Stock Exchange and over 2,800 on the New York Stock Exchange. Plus there are so many more markets across the world to choose from, whether it's Europe, the Far East, South America, Australasia. It's overwhelming. Maybe you'd select the stocks you know. But how do you know if they're good value? Are you overpaying? And what are the prospects like for the company? What if I could highlight an approach that identified a set of shares instantly, giving you the possibility to complete the whole process from identification to purchase in under an hour? A process like this, which selects 25 stocks from the UK stock market every quarter, has returned 255% over the last 7 years and 9 months. That's an annual rate of return of 17.7% for 4 hours worth of work a year. You might be asking, how can I possibly research 25 companies and get them purchased in under an hour? How can that approach have consistently beaten the market? Sounds too good to be true, doesn't it? Well, stay tuned and I'll talk you through it. I've been investing for over 20 years, and when I started, I was following the ideas of other people. I had no independent way of evaluating their investment hypothesis. I tended to invest in stocks that were popular on message boards. The problem with this approach is, I couldn't articulate my case for investing beyond others think it's a good idea. In psychology terms, this is referred to as an external locus of evaluation, in that I refer to external sources to make decisions. When things get challenging, for example, the company releases a disappointing earnings announcement, then what do? Sell? Sit tight? Buy more? All of these options are valid, but they will depend on your investing approach. And if you don't know what your investing approach is, you're stuck waiting for the guy on the forum to tell you what to do. That is categorically not what this channel is about. I'm trying to help you to become an autonomous investor so that you develop an internal locus of evaluation and make choices that are aligned with your investing approach. So there are two types of investors: hunters and farmers. Hunters are able to dissect a set of company accounts, understand a company's business model, understand the business sector, have knowledge of the company's products, their competitors, the key personnel within the organization, the prevailing view of external analysts, etc., etc. With all of this knowledge, the hunter moves in for the kill in the belief they have a surefire winner. It could be that if the share price falls, they will buy more and more stock, believing the cheaper price offers a bargain. Hunters invest a lot of time and energy into analysing an investment opportunity. This can be a very profitable way of investing, but it requires an ability to analyse company accounts, have knowledge of a particular industry and all of the areas that I touched on earlier. And all of this knowledge about just one company can take months to acquire. Farmers, on the other hand, rely on academic research into factors that appear to have a positive impact on investing returns when a basket of these stocks exhibiting these factors is bought as a portfolio when compared to just a random set of stocks. Farmers know if they scatter their investment in factor-rich territory, research suggests their investment portfolio will outperform. That doesn't mean all of the stocks selected will make money. Some might well lose money, but overall, the portfolio should outperform. So if you haven't guessed it by now, I'm a farmer. Get off my land. I'm a factor-based investor. I'm not a financial professional. I'm not a financial advisor. I'm not an accountant. I cannot dissect a set of company accounts. I know a little about the business sectors I've worked in, but there are many sectors where I have little or no knowledge. Does that sound like you? I've stopped trying to kill myself that I can select winning investments through a hunter type approach. It wasn't until I stumbled across factor-based investing that my ego allowed me to own that I wasn't cut out to be a hunter. The shift to a methodical, data-driven, factor-based approach was transformational in terms of my investing performance. I suddenly had my system and I was no longer following others. So what is factor-based investing? Research academics have analysed all sorts of strategies seeking factors that drive outperformance in stocks. Some of the main themes are: high quality companies outperform junk companies. Companies exhibiting strong momentum in terms of their share price appreciation and/or analyst forecasts for predicted earnings outperform companies exhibiting weak momentum. It's the idea that winners keep winning. Companies that are cheap outperform companies that are expensive. So factor-based investors apply a set of factor-based scoring criteria against every stock in their investable universe. The result is every stock in the investable universe receives a factor-based score, with the lowest score being the least desirable and the highest score being the most desirable. To make it easier to compare the scores for each company, you can order each company by the score and then convert the score into a rank, for example ranging from 0 to 100, where 0 is the least desirable and 100 being the most desirable. You could think of it like a league table. By using rankings, it's also possible to divide all of the stocks into buckets. For example, 10 buckets, with each bucket representing 10% of the investable universe. When the stocks are separated into buckets, it's possible to consider the relative performance. For example, you could compare the top 10% against the bottom 10%. So to summarize this first section, there are academically recognized factors that can drive outperformance. Each stock is analyzed and scored against the criteria. The stocks are then ranked according to their score. The investor picks stocks from the most desirable bucket of those rankings, usually the top 5 to 15%. But consider there are 1,100 stocks on the London Stock Exchange. How long would it take you to score and rank each stock? It would take ages, and you'd need to do it each and every day. That's where the advent of the internet and internet-based services have revolutionized factor-based investing. I've been using a service called Stockopedia since 2013. It opened my eyes to factor-based investing, and it has transformed my investing fortunes. Stockopedia takes all of the strain out of factor-based investing, as they do all of the analysis and ranking for all of the stocks in your investable universe. They offer several factor-based ranks: a quality rank, which helps you decide whether the firm is a quality firm or a junk firm; a value rank, which helps you decide whether the company is cheap or expensive; and a momentum rank, which helps you understand whether the company has gained the attention of either the wider stock market or analysts analysing the company. They also offer blended approaches, for example, quality and momentum, value and momentum, and quality and value. And the one I want to focus on in today's video is a blend of quality, value, and momentum, which Stockopedia calls StockRank. Stockopedia produces a stock report for every firm that is listed in its database. The stock report is a consolidation of all of the information regarding one firm, and it's the go-to place when you start looking into a particular individual company. So here I am at the Stockopedia page when I log in. So first, what I'm showing you is a Stockopedia stock report for ITV. I appreciate that all the information presented in the stock report might seem overwhelming, but I want you as a farmer to focus your attention in this top corner initially. Here you can see the quality rank, the value rank, the momentum rank, and then Stockopedia's stock rank, which is a combination of all of these three ranks. You can see the score of the quality rank is 86, suggesting that ITV is in the top 14% of companies in the country within the UK market in terms of quality rank. Its value rank is above average, but it's not in the top 20%. And its momentum rank is in the top 2%. As you can see, the share price is appreciating. And overall, this company has a stock rank of 97%, suggesting that it's in the top 3% of companies when ordered by StockRank. You can click on any of the items in blue to receive a description of that item. So here's the description of the quality rank. the value rank, and the momentum rank. And here you'll notice that it says that the momentum rank is a ranking system based on a blend of price momentum and earnings momentum. And if we look at the momentum panel, this is describing the price momentum, which is one part of the overall momentum rank. The other part is related to earnings momentum, analyst forecasts. So if these figures are improving, then that is positive earnings momentum. And that feeds into the momentum rank. So whilst you could learn about all of this stuff, it's all captured within the ranks, if that makes sense. So for example, if we look at the quality panel, the quality panel describes how the quality rank is formed, and it talks around profitability, cash flow, margins, company risk, and fundamental trend score. Lots of these things are captured here in the quality panel. What these bars indicate, they're trying to give you a sense of the position within the companies, and in this case it's within the industry. So the industry for ITV is media and publishing. And what this bar is trying to show you is how far up the league table of media and publishing companies are they in terms of return on capital. And what the pop-up says is they're third out of 46 companies in the media and publishing market in the UK. And then when you compare them to the overall market, every company, not just media and publishing companies, they're 217th out of 1,767. So these bars try to give you an indication as to the strength of that factor. Okay, so if we come up and look at the growth and value sector, you can see that the PE ratio is in the top third against the industry, and it's 247th out of 922 in the market, whereas the PEG ratio, a measure of the price to the earnings growth, is quite poor. It's 19th out of 22 in the media and publishing industry, and 511th out of 646 in the whole market. So straight away you can see there's a bit of a mixed story around valuation, whereas the quality is strong and there's lots of green on the relative strength stuff for the momentum. You can see that reflected in the score. Quality scores 86, really high. Momentum scores 98, almost as good as it can get. But the value scores, whilst being good, are not up in that top 20%, and that's sort of reflecting the ambivalence in these panels here. So this top right hand corner gives me an instant view on what the company is like without having to dig into all of the detail below or even understand what's going on. Again, this section here, health trend, bankruptcy risk and earnings manipulation. The health trend is trying to highlight, are the financial accounts improving over time or decreasing over time? And for ITV, they're in a good position, they're improving. There doesn't appear to be any particular concerns about bankruptcy, and there's no suggestion that the financial director is manipulating the financial statements and manipulating earnings, because that is so low. So again, there's quite a lot of green on this stock report, indicating that ITV, looks good in lots of ways. There's no guarantee that that will outperform. If we just look briefly down the stock report, we get a share price graph. Underneath that, you also get a StockRank graph that shows how the StockRank wanders over time. So at the moment, it's right as high as it's been for a long time. What else? Any of these items, these are items from the financial filings from the company. So this is how much money the company has earned in terms of sales in 2015, 16, 17. And whenever you hover over any of these, you get a bar graph. So operating profit, net profit. These are quite good at glimpsing behavior. Or, it's a bit worrying here, is that you just see a declining margin. It means it's getting harder for ITV to make money. So that's a bit of a concern. There's some graphical representations of those things that we've just looked up above. Reported revenue. It's been a drop off in 2020. And then there's projected earnings for 2021 and 2022. Same with income. This is profit, and then how much that profit is worth per share in the company. I touched earlier on analyst forecast. This is about what analysts who work for investment firms think of ITV. There's 17 brokers currently valuing ITV, and they're all trying to work out how much they think they'll earn. So these are the forecasts. There's a description of who the organisation are and what they do. Who are the key people within the organisation? Their filing dates, when they need to file their financial statements. Which sector they belong to. The ITV is part of the consumer cyclical sector, and they work within the media and publishing industry. I'll talk more about that for new starters who have no exposure to the stock market in another video. It tells you what index they're in. They're part of the All Share Index and part of the 250 index, so they're probably within the to be in the 250 index, you have to be one of the 250th largest companies within the UK. Tells you that it's eligible for an ISA or a SIP, which are both tax-free wrappers that you can invest through. Down the bottom there's any news that has come out recently about ITV. So obviously they've done an interview with Meghan Markle recently, and so there's been lots of response to that. Coming back up to the top, there's all sorts of tools where you can run checklists. You can look in more detail at their accounts, and you can see what major shareholders have. You can look at more detail in the share price charts, and there's various ways of viewing that, which I'll cover in future videos. You can look at a detailed view of the news, which we saw down below. And then, you know, a really useful feature is Stockopedia has a community. And so people will be talking about various stocks and shares. And if that's interesting to you, then you can get and look and see who's been talking about ITV. So all of these articles here have got ITV mentioned in them. So there's advice for a novice investor here. Somebody's asking ITV and major shareholders, what am I missing? And then the community responds. There's comments from other members of the community. Let's look at an alternative stock report, and for this one I'm going to look at Aston Martin. Aston Martin is a luxury car manufacturer. They design, manufacture, distribute their cars. And I'm hoping what you're noticing is that you're moving straight away to the top right hand corner to get an overall view of where this stock's at. And straight away you can see it's got a quality score of 12. It's in the bottom 12% in terms of quality, in terms of companies within the UK. Value is 22%, momentum 52%. And overall it's got a stock rank of 15, and when a rank is in the bottom 20%, it's highlighted in red. So the quality and stock rank in this case are highlighted in red. So straight away warning signs are flashing. And actually if you come down and look at the panels, a lot of the values in here are not applicable. And the bars are over as far left as they can be. It's valued 0 out of 7, 0 out of 5. 0 out of 5. And the reason it's not applicable in this section is because if we come down, so there's the revenue for Aston Martin, but here's the profit. The reason those ratios can't be generated is because Aston Martin's not making a profit. So straight away, that's another big problem for me anyway. I don't tend to invest in companies that aren't making a profit. So straight away, there's lots of red on this stock report. There's amber in valuation. There's a mix of colours in the momentum. And the quality scores, you know, it's 8 out of 9 automobile and auto parts market. So that means even if the car market was booming, there's still 8th out of the 9 companies in that operating in that field. So do you really want to buy the 8th out of 9 companies in automobiles in the UK? I'm not sure that I do. If you look at their health trend, their finances are deteriorating, not improving. And, you know, there's a suggestion that there's a risk of bankruptcy. And in fact, from memory, I think Aston Martin have been laying off staff, unfortunately. And so they're having to take drastic action. You know, again, you can see, if I highlight a graph, their margins have just fallen right through the floor. Really difficult times. So I'm hoping there you get a sense of what a different stock report looks like for a strong company and what one looks like for a weak company. I don't need to know all of the detail about this stuff or what it means, because the data and the financial ratios are synthesized into the quality, value and momentum ranks and then combined to form a stock rank. Okay, so we know what the difference is between a high stock rank and a low stock rank. Well, what difference does that make? Show me why I should choose a high stock rank over a low stock rank. So here we are on another part of the Stockopedia website, and I'm using a tool here which allows us to analyze the performance of various ranks over time. And at the moment I've configured the tool to look at the UK market, companies that are over £10 million. And I've asked it to organize them into 5 portfolios, 5 portfolios, each containing 20% of the stocks that are over £10 million. So maybe that's like 400 stocks per portfolio. So the first portfolio contains stocks that have a stock rank of 80 to 100. The next portfolio contains stocks that have a stock rank of 60 to 80. The next one 40 to 60. The next one 20 to 40. And the last one, the one in red, is the bottom 20%, 0 to 20. And for completeness, we've got the FTSE All Share on there just to show performance. Just to help us out, I'm just going to take out the middle ones so we've got a clearer view. So what this has shown us is that from April 2013 right up to the present day, the FTSE All Share has returned 15.5%. The top 20% of stock ranks have returned 150%, whereas the bottom 20% of stock ranks have only returned 1%. And in fact, if you look at the graph, it's only post-pandemic that the bottom 20% have sort of rescued themselves really. All the rest of the time they've really been struggling. And even post-pandemic there's been a huge drop in the top 20%, but they recovered really aggressively and really quickly. So at the moment I've configured this graph to rebalance annually. So what that means is, if I put the other portfolios back in, at the beginning of this period, the portfolios were constructed with 400 companies in each. And because I'm asking to rebalance annually, what I'm saying is in a year's time, so April the 5th, 2014, I come in and I sell all of the stocks in all of the portfolios, and then I re-look at the league table again, and I re-chop them up into 5 portfolios, and I reassign them back into their appropriate portfolios. So it's rebalanced, that's what that's called. And so that would have been done each year on the anniversary date. And so for the top 20% rebalanced annually, we get 150%. Let's see what happens if we move to rebalancing more frequently, every 6 months. So again, the top 20% is just a bit of an improvement, 154%, say. And again, if we move to more aggressively again, we rebalance quarterly now, we get a value of 163%. So there is improved performance, but the downside of rebalancing quarterly is you get increased transaction fees, potentially depending on which broker you're using, and it takes more of your time. Okay, so this may or may not be worth doing that. So let's just go back to annually a second. Let's see what happens if we switch, rather than organizing the portfolios, organizing the stocks into 5 portfolios, what happens if we organize it into 10 groups of 10%. So again, there's a good spread of portfolios, and what I'm going to do to make it easier to read is I'm going to take out the middle portfolio so you can see a little bit more clearly. So now what we see is that the top 10% returns a whopping 187% performance, whereas the next 10% down, the 80 to 90, only returns 120. So a significant improvement. And if we move that to 6 monthly rebalancing, (182%). And if we go to quarterly, suddenly there's a jump up to 210%. So that's a big leap. And again, you need to weigh up whether that extra effort of rebalancing is worth the extra returns. Okay, so let's just take a step back. This graph is showing us the StockRank's performance history for the whole of the top 10%, 90 to 100, over 10 million rebalanced quarterly. But that's probably around 150 to 200 stocks. We're not going to buy 150 to 200 stocks into our portfolio. So how are we going to do that, and how does it manage in terms of its performance? So to explain that, I need to outline another sort of feature of the Stockopedia website, and that's the idea of screening. Stockopedia has about 63,000 stocks in its database. So how on earth do we find what we want to invest in? And the way we do that is we use screens. Screens are basically a set of rules that allow us to specify conditions that we need our stocks to match in order for us to want to view them. And so Stockopedia has some inbuilt screens that are mainly based around its ranks, so stock ranks, and combinations of the quality and momentum rank, value and momentum, quality and value, quality rank on its own, value rank on its own, momentum rank on its own. There's a growth one as well. So there's a variety of Stockopedia screens. And then there are screens called guru screens, and these are screens based on investment principles from financial legends. So individuals, for example, such as James O'Shaughnessy, who wrote about Tiny Titans, or William O'Neill, who wrote the Can Slim strategy, or Jim Slater, who wrote Zulu Principle. And these are organised around the idea of quality investing, growth investing, value investing. They're fantastic, okay? But what's happened with Stockopedia is they've taken these ideas that these gurus have come up with and the research that's backed around academic research, and they sort of synthesized them into their fundamental quality, value and momentum rank, and those three feed into the stock rank. And they also inform the blended ranks, which are the QM rank, the VM rank and the QV rank. We'll look at them in the future. So let's look at the stock ranks screen. So stock rank screen comes with a description which tells you a little bit more about it. This stock rank screen has got three rules. It asks for stocks that have a stock rank of greater than or equal to 40%. The company must have a market capitalisation of more than £10 million. And it wants the results ordered by the size of their stock rank decreasing. And so what we see below is all of the stocks that satisfy that criteria, and they're listed here. There's 17 pages worth. And you'll see that they have a variety of market caps. All of them will be over 40 million because that's what we asked for. And you can see they come from a variety of sectors. And if you hover over a stock, you get a bit of a summary. Okay, so this is the bit I want to show you, the performance section. So this graph is slightly different, and the way the portfolio is constructed is slightly different to the performance graph we were looking at before. In 2013, this screen will have been run, and you would select the top 25 stocks from this screen. That's it, simple as that. Placed in a portfolio, and then that portfolio is rebalanced every quarter. So 4 times a year, run the screen, select the stocks, switch out any ones to rebalance everything, and we're off to the races again. Okay, so this has been running since June 2013 right up to present day, and over that time period the FTSE All Share has returned 20%, whereas this screen has returned 255%, and that works out at an annualized rate of 17.77%, which is remarkable. That is a huge outperformance. And look at this massive drop as a result of the pandemic, but a really strong and smooth recovery. And it's quite a smooth graph, which is what I'm looking for. You know, what you need to bear in mind, that there will be times, so for example, if I look at 2018 to 2019, there will be times where the screen doesn't perform. You would have probably lost a bit of money in 2000 to 2019. But overall, the performance of the graph is really, really good and smooth, which is what I'm looking for. Overall, this screen selects stocks with a stock rank of 99, which is no surprise because we're asking for the top stocks, so that's why. I hope so far I've been able to highlight that portfolios constructed of high stock rank stocks outperform low stock rank stocks in the UK market. It's important to remember that past performance doesn't guarantee this model is going to perform in the same way in the future. With that caveat in place, let's look at the rate of return in practice for you with some examples. What does this actually mean in terms of your money? So what I've done is just produced a little spreadsheet to help you consider the behavior of compound interest. So I went to check out what sort of interest rates I'd get from a bank if I was prepared to tie my money up for 5 years, and I found one and it was 1.3%. So let's just plug that ratio into this spreadsheet, and maybe I've got £1,000 that I'm able to invest. So I'll put that in the initial investment box. So there we go, £1,000. And what you see is that the table now populates with figures. You can see in the first year I get a gain of £13. And over the course of the 10 years, my money appreciates at about £13–14 a year, until eventually in the final year, year 10, I get a whopping £15. So I take my initial investment of £1,000. Over 10 years, I get a final value of £1,138 for a total gain of £138. It's not exactly going to pay for your kids' education, is it? So what happens if each year I keep adding £1,000 into the pot? Let's see what happens when I do that. So now you can see the end of year total is £10,744 from an initial £1,000 investment plus 9 further investments of £1,000, giving you just a total gain of £744. Still, it's not fantastic, is it? £744 from a £10,000 investment. Okay, so let's see what happens if we just start with our initial investment of £1,000 and the historical StockRank's annualized return rate of 17.77%. Remember, in that initial £1,000 investment at 1.3%, the total gain was £138. Let's see how that compares. Our investment of £1,000 grows to £5,133 over the course of 10 years. The gain in the last year alone is £774. That's the power of compound interest. Look what happens if we keep investing £1,000 every year now. Let's see how much difference that makes. So now over the course of the investment, we've invested £10,000. We get a final value of £27,389 and a gain of £17,389. That's huge. Massive return for your investment just from saving £1,000 and £1,000 every year after that and investing it in this way. What would it be like if it was £3,000 and £3,000 annual investment? Starting to get some big numbers now. Your total investment of £30,000. Your final value is £82,000, a gain of over £52,000. Look at the gain in the last year, £12,400 just from the last year's gain. Big swings now as compound interest really takes hold. What seemed like modest gains initially, £533, still a lot of money. It seems quite modest, but 12,398 in the last year. What if we could, say, make an initial deposit of £10,000 and a contribution of £10,000 each year? Now we're talking serious money. Total investment of £100,000. Final value of £273,894. A huge gain of £173,894. You start off with a £1,700 gain in the first year. By the end of year 10, you've got a £41,000 gain just in 1 year. What if you could do your full ISA allowance each year? £20,000 deposit and an annual investment of £20,000. That's about the limit of an ISA. Total investment £200,000. Now you've got a final value of £547,000 and a gain of £347,000. Massive, life-changing, huge figures. A gain in the last year alone of £82,000. So that's why I'm so keen to get people invested in the stock market. It is transformative. So far we've looked at the UK markets, and I'm conscious that you may be viewing this video from all over the world. Hello, wherever you are. No doubt you're asking, does this approach work in my local region? Perhaps you can let me know where you're based in the comments below. Any approach to investing will at some stage have periods of underperformance, as I've highlighted earlier. Also, some stock markets behave in different ways. For example, the StockRank model, a blend of quality, value and momentum, doesn't work well in US markets, but the growth rank appears to work really well. In some markets, including the UK and Europe, a blend of quality and momentum works really well. Also, a blend of value and momentum is good too. Over the coming weeks and months, I'll look to highlight what has worked well in UK, Europe, US, India, Canada and developed Asia, which covers Japan, China, Taiwan and South Korea. I'll also look to highlight more features of Stockopedia, which is integral to my approach. If you're interested in signing up to Stockopedia, I've secured a great deal for you. If you follow the link I've posted in the description below, you'll get a 25% discount on your first year of an annual plan. That deal comes with a 14-day free trial and a 30-day money-back guarantee. I recognise for some the annual subscription might be challenging, but I can tell you it's the best decision I've ever made in my investment journey. By signing up through my link, I get a referral fee, which really helps me to develop the channel. But I really want to reassure you that I'd only be linking to and referring to channels and services that I think will really benefit you. So today I've introduced you to the idea of factor-based investing and outlined the idea of being a farmer who buys a basket of stocks with certain factor-based characteristics that should generate outperformance. I've introduced you to Stockopedia and highlighted how their StockRank is presented on their stock reports. I've highlighted the outperformance of the top 20% of stock ranks and the underperformance of the bottom 20% in the UK markets. I tried to give you a sense of how compound interest can generate huge returns over time. I've highlighted that not all markets work with the same approach, and in future videos we'll explore this further. I really hope you found the video useful. If you have, can you please give me a thumbs up? Please consider subscribing and hitting the bell icon if you'd like to be notified when I publish my next video. I'd love to hear some feedback in the comments, so if there's something you don't understand, then please leave a comment and I'll do my best to respond. For the investing novices out there, I'm going to be developing more videos to help you get to the stage where you are ready to place your first trade. For those that are financially challenged, I'm also trying to plot a path forward for you using this approach. Stay tuned for future videos that will help you to grow your dough so you can secure your future.